So to start this section off, I'm going to teach you one of, if not the most important skills you must learn to trade supply and demand, that being how to find supply and demand zones on your chart. Now, I'm not going to lie to you guys, finding supply and demand zones isn't easy, okay? It's not something you're instantly going to pick up just from watching this video. You'll need to spend some time finding zones yourself or using your own charts. That's the only way you'll get it into your head. It takes practice, just like anything in life. However, with that said, once you know how to find the zones, finding them becomes really easy. And luckily, I know a few quick tips to make finding the zones a breeze. That's what I'm going to show you in this video. Before I show you how to draw the zones, however, I want to give you some background on how supply and demand zones actually form in the market, because there's a reason why the zones form where they do, and it's only by understanding this that you'll know how to find the zones later on. So, ready to get started? Let's jump in. Now, in part 1, I explained that supply and demand zones all form due to the banks buying or selling, from placing trades, taking profits, or on occasion closing trades. Every zone, no matter where or when it forms, has been created from the banks carrying out one of those three actions. Now, one of the most important facts to understand in supply and demand, and Forex in general really, is the banks can only buy or sell when other traders are doing the opposite to what they want to do, okay? If the banks want to place a buy trade, other traders must be selling, because that's the only way the banks can buy. If they want to take profits off a sell trade, which requires you to buy back what you sold, remember, the banks need other traders to be buying. And this must be at the same time too. Nobody buying when the banks want to sell, guess what? They can't sell. Again, it's just like how buying and selling functions in a real market. If you want to buy a new car or phone, someone must be willing to sell it to you. If you want to sell your new car or phone, someone must want to buy it from you. Otherwise, the transaction can't take place. That's how buying and selling functions in Forex, but on a much grander scale. Buyers need sellers and sellers need buyers. Always remember this. Now, here's a really key point. In Forex, the banks don't buy or sell when price is actually rising or falling. In other words, if you see price rising and bull candles are forming, that isn't the banks buying. It's normal traders buying and shorts closing out losing sell trades. That's what's causing price to rise. For the banks, it's not possible to buy or sell when price is rising or falling, respectively, for one simple reason: size. When the banks buy or sell, they do so in massive quantities. And since buyers need sellers and vice versa, like I just explained, that means the banks require thousands of traders doing the opposite for them to be able to buy or sell themselves. If they, the banks, want to buy, they need thousands of sellers. If they want to sell, they need thousands of buyers. The bigger the number, the more they can buy or sell. Now, if price is rising, what are most traders doing? They're buying, right? That's why it's rising. So the banks can't buy, not enough traders are selling. For the banks to buy, they need thousands and thousands of sellers. That's the only way they can enter their massive buy positions, whether it's to place buy trades, take profits off sell trades, which requires them to buy, or close existing sell trades. The banks can only do any of those actions with thousands of opposing sellers. And this brings us to a really important fact. The banks don't buy or sell when price is actually rising or falling. They buy or sell before the rise or decline started, back when price was moving in the opposite direction, because that's when most traders were doing the opposite, buying or selling. So if we look at this large rise here, let me just zoom in quickly. The banks didn't buy during this up move when price was actually rising, i.e. when you see bull candles forming. That's not the banks buying. It's retail traders, people like you and me buying. The banks bought down here where this rise began. Because what was price doing back then? What was price doing here? It was falling. Price had been falling for a while, so most traders were selling. The banks can only enter big buy positions if they have lots of sellers, so they entered when price was still falling, down here, before this rise even began. Once they entered, that's when price started rising, creating our demand zone. Does that make sense now? Do you see why the banks must sell when price is rising and buy when it's falling? Make a note of this somewhere, because it's a key concept you must understand. So, why is this important for us finding supply and demand zones? Well, since the banks can only buy or sell when lots of other traders are doing the opposite, it means the point they buy or sell to initiate every rise or decline is the beginning of the rise or decline itself, because that's when most traders are doing the opposite, as price is moving in the prior direction, okay? So, to find supply and demand zones, we locate the sources of rise and declines. That's where the banks enter their positions to cause price to rise or fall and create the zones. Take a look at this chart. Cast your eyes on all the rises and declines you can see. Now look at the source of each rise and decline, where they originated from. At that point exists either a supply or demand zone. If it's the beginning of an upswing, it's a demand zone. If it's the source of a downswing, it's a supply zone. You can see we've got one down here, this is a demand zone. Another one here that set off this upswing you can see. Up here we have a couple of supply zones, this one and this one. They formed at the beginning of these downswings. These zones all form at the source of each rise or decline because that's where the banks bought or sold to cause price to rise or fall in the first place. Here's what it looks like with some zones marked. Keep in mind, these are just a few of the zones in this bit of price action. There are more, I just haven't marked them all. So hopefully now you understand why supply and demand zones form at the sources of rises and declines, and why that's the point we need to mark when finding the zones ourselves. It's where the banks bought or sold to cause the rise or decline and create the zone. If the banks need to buy or sell again, that's the point it'll most likely return to, and so the point we need to watch for our entry signals. Now, let me give you a step-by-step walkthrough of how to find the zones yourself, beginning with step 1, start on a higher time frame. So, to find supply and demand zones, you need to locate points where upswings and downswings originate from, because that's where the banks enter their positions to cause the zone to form. The easiest way to do this is to go up a time frame or two above whatever your trade time frame is, the time frame you analyse price with, and take trades off. That'll remove the noise and give you a clear idea of where each swing begins. Now obviously, which time frames you need to switch to depends on what time frame you trade off, so I'm going to flash up a quick list of which time frames I think are best based on your trade time frame. Got that down? Let's continue. Okay, finding the zones. What do you need to do? For this example, I'm going to find a bunch of zones on a 1 hour time frame. That's my trade/analysis time frame. So I'm going to switch up to a higher time frame, the 4 hour, to find the zones, since that makes the swings easier to spot. Key point, always mark higher time frame zones in a different colour. Higher time frame zones are stronger than lower time frame zones, and that scales with time frame. The higher the time frame, the stronger the zone. So these 4 hour zones will probably generate bigger reversals than the 1 hour, meaning it's important to distinguish them in a different colour. First things first then, we need to find the points where upswings and downswings originate from. Those are the points the banks bought or sold to create the swing, and thus where supply and demand zones are located. Starting from the middle then, we have an upswing, and this upswing originated down here, at the point where price stopped falling and started rising. So we mark this as a demand zone. This is where the banks entered their buy positions to cause the rise, because that's when most traders were selling. Moving forward, a couple of weeks after the upswing begins, price reverses and a downswing takes place. So we find the source and mark this as a supply zone, because it's where the banks enter their sell positions to initiate the decline. Remember, don't worry too much about marking the zones correctly at the minute. That'll come later on. For now, just concentrate on finding where the zones are formed and understanding the process we use to find them. That's the most important thing to take from this. I'll explain how to draw the zones step by step in the next video, so don't get too caught up in the whole am I marking them correctly, because we'll cover that later on. So here's how the chart looks with the zones marked. Now let's move on to step 2. With the zones marked on the 4 hour, it's time to switch back to our trade time frame, the 1 hour in this case. The 4 hour helped us find the most obvious zones, but now we need to find the hidden zones, the zones only clear and visible on the 1 hour. So let's do that. Right away, it's clear, the 1 hour shows a lot more swings than the 4 hour. Does that mean more supply and demand zones exist? Kind of. More zones exist because more swings are visible. However, that doesn't necessarily mean they're all good zones, far from it. Many, if not most of these swings, reveal terrible supply and demand zones, zones with little to no chance of causing any kind of significant reversal. So what's the point of marking them then? Shouldn't we leave the weak zones and concentrate only on the best? Well, not really. See, weak zones, though they may not initiate the biggest reversals, usually set off small retracements, minor pauses, or consolidations. By marking them alongside our other zones, we can build up a roadmap of where and when price is likely to reverse, retrace, pause, or consolidate. We can basically map out what the market is likely going to do before it does it, helping us determine which zones to concentrate on and expect the biggest reactions from. Let's mark the zones now. Starting from the middle again, we have this week-long down move, which contains multiple downswings and thus supply zones. We've got one at the top here, another 100 or so points below, which is a tiny zone, and then another one just below that, which caused the biggest downswing. Each of these small swings contains a supply zone at the source, so we must mark them on the chart, as I'm doing now. Key point, get into the habit of identifying zones by their type. Either mark it down or just keep a mental note to yourself whether a zone is a rally-based rally or drop-based drop zone, or rally-based drop, drop-based rally zone. The zones I'm marking now on this up move are all rally-based rally zones. Why? Because they all form from price rising, that's the rally, then pausing or retracing slightly, that's the base, before rising again, that's the last rally. That process creates rally-based rally zones. On average, rally-based rally and drop-based drop zones are weaker than their rally-based drop and drop-based rally counterparts. This is down to the fact they form when price has already moved in the direction the banks want to enter their positions in, okay? For example, for a rally-based rally zone to form, price must rise. That means most traders are buying, not selling. So the banks, who want to buy and thus create the zone, can't buy in large quantities, not enough traders are selling. they could only buy a small amount, which is why price rises again, but not by much, causing a weak demand zone to form. Now, this doesn't mean rally-based rally and drop-based drop zones aren't worth watching, or won't set off large reversals from time to time, because they will. It just means that usually the reaction will be much smaller, and a retracement or pause is more likely. All our zones are now marked and ready to trade. Our 4-hour zones, marked in green, will be our strongest zones. Expect the largest reversals here. And our 1-hour zones, in brown, are all weaker, so will probably generate smaller reactions. Now, let's move on to the next video, and I'll show you how to actually draw supply and demand zones on your chart.